Welcome back to This Week in Finance, where we cover everything finance, business, investing, and property related in the UK. Now, today my ears are a bit clogged, meaning I can't actually hear myself talk very well, so please drop one of these as it does help with the YouTube algorithm. An article on This Is Money. City watchdog plots crackdown on finfluencers in shake-up of social media financial promotion rules. Finfluencers, individuals or accounts building large followings for their financial hints and tips. Many have large youth fan bases on highly popular online platforms, including Twitter, YouTube, TikTok, and the live streaming app Twitch. Twitch? Who's watching finance on Twitch? What's going on over there? Around 3/4 of 18 to 29-year-olds who follow finfluencers say they trust their information, while 90% of them admit of acting on their advice. However, the FCA said finfluencers often have little knowledge about the products they are marketing, and for those touting products illegally, we will be taking action against you. Financial memes are being circulated increasingly on social media, particularly with regard to crypto assets. But those memes can constitute a financial promotion, the FCA warned. The watchdog is banning incentives to invest in crypto, such as refer a friend bonuses. I have seen a growth in a trend where a lot of YouTubers that don't get many views at first, they start to almost shill on certain stocks or cryptocurrencies. They can get high levels of views, and then what they'll do is they'll start to provide daily updates on these coins, promoting a certain sense of urgency, and they'll end up making a lot of income through refer a friend bonuses. More than ever, finance YouTubers should be very, very cautious on the content that they upload and be mindful that they can reach out to an audience that may be easily convinced into buying such assets. The rise of the retired renter. 1 million pensioner households will be tenants in a decade's time. As households get onto the ladder later in life, over the next decade, there's likely to be an increase in older households still paying off their mortgage beyond the age of 65. However, this increase is likely to be a small fraction of the growing number who will be paying rent beyond the pensionable age. Today's households aged 65 and above currently have some of the highest homeowner rates in history. However, a survey suggests that the age groups succeeding them are nearly twice as likely to rent privately. It's long been the case that if you're not on the ladder by 40 years old, it becomes more difficult. Back then, for them, properties were easier to acquire based on a multiple of their salary. These days, that multiple is a much larger figure, and therefore I'm not really surprised the fact that we're going to see a larger proportion of renters going into a longer term future. What does make me curious is this going to be almost a cyclical trend? In 50 years time actually reverses and swings back the other way. Sellers still want more for homes despite the mortgage crunch. Asking prices have edged up 2.6% since the start of the year. Rightmove said that although asking prices rose annually at the slowest pace since the end of 2019, they were still going up. But many sellers are proving to be overly confident as there has been a rise in the number of properties seeing asking prices cut after they initially got on the market and failed to sell. The biggest mortgage leader, Halifax, has revealed that house prices have fallen at their fastest rate in 12 years this month, dropping by about £7,500 on average over the past year. I think that this article is particularly misleading. It may indicate that house prices are on the up, but this is simply the asking price by the seller, who naturally is going to have their listings for higher than likely their fair value, but then they'll come to a realistic term when they realize it doesn't sell, as mentioned here with the stat showing that sales agreed actually lower than 2019's level. I think this is normal. We've obviously got very high interest rates. We're likely going to see a further squeeze on house prices as time goes on. That said, inflation has actually fallen, which has dragged sterling down. Now, inflation has fallen down to 7.9% in June, down from 8.7% in the previous month. And that's because as inflation figure has come in less than forecast, the expected overall interest rate rises are likely going to be less than anticipation. Therefore, the pound, which was increasing in anticipation of a slightly higher inflation forecast, has now decreased as the market reflects that true rate. The reason it has done this is because a lot of people or a lot of foreign investors are looking for a place to save their money. They look at the UK and go, okay, inflation's still high, therefore interest rates are going to increase or continue to increase, therefore we can put our money in here for the short term to get a good savings rate on our capital, and also in a relatively safe position as the UK pound is one of the more stable currencies in the world. There's a good quote here actually, and I like this, and it says that at the moment the UK consumer continues to defy the doom mongers. Now it talks about retail sales here coming in much stronger than expected, and this is despite fears of soaring mortgage costs and stubborn inflation dominating the news flow for over a month. And it says here, I'm reminded of a well-known quote describing economics. If you are not a little confused, you don't understand it. An article on This Is Money suggests there's a new stealth tax attacks on inherited pension pots being mounted by the government, warns experts. A new stealth tax attack, that's a mouthful to say, on pensions inherited from loved ones aged under 75 is being mulled by the government and risks throwing inheritance plans into disarray over changes that could take effect on the 6th of April 2024. Under current rules, if you die before age 75 and haven't yet accessed your pension, your beneficiaries can inherit your defined contribution pension completely tax-free if it is under the lifetime allowance. However, with the new rules, where someone dies before age 75 and they choose to access as yet untouched inherited pension as income, the entire amount will be subject to income tax. By contrast, if the same person took the inherited pension as a lump sum and it was within the 1,073,000 lump sum limit, it would remain tax-free. It goes to show you can't rely really on the pensions to be the same in the future. I'm personally not as bothered by this because I don't rely on windfalls. Now, some of my family may have some capital that they wish to pass down. I've personally told them that I'm not interested in it. You can donate all of that or spend it all in your life and do what you wish with it. The reason behind this is I don't believe in generational wealth. I think that despite the hard work, let's say, by the other generations and the fact that they want to give back, I think that this creates or instills a laziness in form of those next generations. I personally believe that if you start poor, you can be very motivated and driven to make that capital over your life. I think to be handed money at a young age or just be given it through generation wealth, it makes you an entitled person, a person that lacks drive and a person that lacks perspective. Truthfully, I think you need to grow up on the poorer side of the spectrum in order to really appreciate being rich. Now onto the trending tickers of the week on Yahoo Finance. The company announced it's buying Angstrom Sports, if I said that correctly, which is a provider of sports modeling. Now I don't think it means as in models on a catwalk wearing sports clothing. I've said here that the acquisition it secures is the only global operator with a full in-house suite of end-to-end analytics, risk and pricing capabilities for US sport betting and products. The company also said that the enriched in-house capabilities will provide a significantly greater number of betting opportunities, as well as accelerating pricing expertise and risk management, delivering margin enhancement over the longer term. Entain is interesting. There's a lot of deregulation in the US following gambling betting that wasn't as much of a thing in the past. Now there's a big rush to get to the US and dominate in sports betting. DFS Furniture, we always see those adverts all the time, said it was on track to achieve profits of over £30 million for the full year of 2023. The group said it also expects to achieve profit growth next year. The furniture company highlighted that it is uncertain about the broader market environment, with market volumes down 15 to 20% this year as consumer demand is being impacted by the macroeconomic environment. Truthfully, I am not so surprised by the volume decrease in the market here for DFS. If you're selling furniture, this is likely something that isn't a necessity to get updated. After all, they might go, okay, well, I've bought a sofa, I've bought a closet, but these are durable items. These are likely to last for, let's say, the next 5 or maybe even 10 years here. Therefore, I think they're going to see a bit more of a pinch in the few years going forward. EasyJet saw its spring profits beat analyst expectations as demand for foreign holidays boomed in the midst of this cost of living crisis. The airline reported a pre-tax profit of £203 million, which is £42 million more than the analyst forecast. Revenue per seat, which is a key metric of profitability, rose 23% year on year, with a forecast of a 10% annual increase over the following quarter. Winter bookings were up by more than 100% year on year, as EasyJet had said it increased its planned capacity by 15% to meet the needs of strong winter demand. The trouble is with airline businesses is that they have to invest significant amounts of capital to actually make money. Let's say a flight goes potentially wrong, then you've got a lot of reputational damage on the cards as well. Babcock profits plunged on a dispute with the Ministry of Defence. The firm reported a jump in annual revenues, but said it had made excellent progress despite the profit slide. Revenues for the year rose 8%, while the contract backlog rose 7% organically. Although operating profits fell to £45.5 million from £226.8 million a year previously, after the group was hit by a £100 million loss on a Type 31 frigate contract. They mentioned here that they remain committed to reinstating the dividend and that they've made excellent progress this year with better than expected cash generation, margin expansion and double-digit revenue growth. It's likely here though that they've got a very positive free cash flow, and the positive free cash flow, as they mentioned by cash generation, is what is really driving the business behind the scenes here. And I suspect here this £100 million loss was perhaps not a cash loss, but that of an asset or something where they're not actually losing £100 million. Glencore is a company that I have overlooked. It's a mining giant that kind of focuses on like coal, I believe oil, LNG, which I think is liquid something gas, which I think is relevant to energy prices. So it could be a commodity play here in terms of energy, and maybe one that I've overlooked. Now, they're saying that their annual profits are actually between $3.5 to $4 billion, compared to $6.4 billion last year. Glencore's mining segment saw an increase in output for copper, zinc and nickel in the second half, meaning it reiterated its full year forecasts. HSBC stock headed to a 4-year high on Friday as the London headquartered bank said it had benefited from a rebound in Hong Kong's interbank lending rates. It announced a $2 billion share buyback plan and resumption of quarterly dividend payments in May. Whilst over the last 5 years HSBC is still down, this appears to be the bank that has recovered the most, especially when we look at the great financial crisis, albeit it hasn't recovered. But if you look at other UK listed banks, they've not recovered whatsoever. We were talking about Ocado last week, but it says here that the stock has actually jumped quite a lot as its earnings report revealed a return to underlying profit for the first half of the year. Its tech, which has created new ways to guide robots in warehouses, has helped it scope new international clients such as Kroger in the US and Aeon in Japan. Core earnings hit £16.6 million, ahead of a consensus forecast for a loss of £16 million and reversing a loss of £13.6 million in the year earlier period. EBITDA of £16.6 million does not make a $5 billion company. That said, Ocado shares are still on quite a massive downtrend following the peak in March 2021. Now, my stock portfolio has actually fared all right this week. Shares are up over the last 7 days by about £300 to £400, and it appears to be because Games Workshop is dragging up the portfolio. Again, I'm very mindful that my exposure to Games Workshop here is very much on the high end, and this reflects a similar mistake that I made in Boohoo, except with Boohoo I was very much buying a falling share, which then took up a way too large exposure in my portfolio. That said, Boohoo's been a bit weak as of the last 2.5 years, and at the moment, despite Boohoo shares stagnating and dropping down at the end of the week on Friday, it appears that Games Workshop has dragged the portfolio up. At the moment, I'm actually paying close attention to the likes of Alphabet, because it's vital that I diversify and really get a good position. That said, if we look at the max history of my portfolio, I'm nearly reaching all-time highs, albeit this is very much misconstrued because I've made deposits of a lot since the last time I reached this amount in the past. And don't forget that I'm down by this whopping figure at the top of the page, and that's likely to stay the same for quite some time. Recently, HMRC has cracked down on ISA investors. Now, if you want to learn more about this, it's vital that you click this video right here. Thank you for watching. Have a fantastic day.